If you're an NRI with property back in India, you probably know this feeling. What should be a really valuable asset often feels more like a locked-up liability, right? The amount of red tape can be just overwhelming. Well, in this explainer, we're going to give you the keys to unlock that value. We're going to demystify the entire sales process from start to finish. So let's jump right in with the first, and honestly, the biggest shock for most people.
Okay, the very first hurdle, and believe me, this is the one that catches almost every single NRI off guard, is a massive upfront tax deduction. It's a real shock to the system, mainly because it happens right at the very beginning of the deal, before you've even seen a single rupee of profit. We're talking about a default tax deduction of anywhere from 20 to 30%. And here's the crucial detail, the part that trips everyone up. This is not a tax on your profit. This is deducted from the entire sale price of the property. Just let that sink in for a second. A huge chunk of your money is gone before your actual gains are even part of the conversation.
So let me just ask that again because it's that important. Could you really have nearly a third of your property's value held back right from the get-go? And the answer, by default, is a shocking yes. That money can be tied up for years, which means the financial stakes here are incredibly, incredibly high.
And look, this isn't just some theory. Check out this real-world example. A Dubai-based NRI sells a flat for 1.2 crore rupees. The buyer, just following the rules, deducts a whopping 27.4 lakh in taxes. But here's the thing, the seller's actual tax bill was only 3.8 lakh. That means almost 24 lakh rupees were just stuck with the tax department for no reason, and it took 14 long months to get that money back.
So what in the world is causing this? It's a system called Tax Deducted at Source, or TDS. And there's a specific rule for payments to NRIs that forces the buyer to withhold this tax. Now, why is the rate so crazy high? Well, it's simple really. The tax office just assumes the worst-case scenario and applies that high rate to the entire sale value, not your actual and probably much, much smaller capital gain.
Okay, so that's the problem, and it is a big one. But the good news is, there is a solution, and it's a really powerful one. Let's talk about what I like to call the golden key that unlocks this whole situation and puts you right back in control.
This key is called a lower TDS certificate, or an LDC. Think of it as an official order you get from the tax department before you sell. It's a direct instruction to your buyer that basically says, hey, don't you dare deduct that huge 20–30% default amount. Instead, deduct this much smaller, correct amount that's based on the seller's actual profit. You know what? In some cases, that amount can even be zero. The difference this one piece of paper makes is it's night and day. Without an LDC, you're looking at that huge 20–30% deduction, a massive blockage of your own cash, and you're waiting 1, maybe 2 years for a refund. But with an LDC, that deduction plummets to just 0 to 3%. You get immediate access to your money, and there's no refund hassle whatsoever. It's a game changer. So how do you get one? It's a very clear 6-step process. First, you get your ducks in a row. You calculate your actual capital gains and gather all your documents. Then you file the official application online. After that, you'll probably have to respond to a few questions from the tax officer. Once they're satisfied, boom, you get the certificate. And all you have to do is give that to your buyer. It's a process, for sure, but it is absolutely manageable.
So getting the tax figured out is the first major hurdle. But even if you have a perfect LDC, there's another pitfall that can completely derail your sale, the paper trail. Your documentation has to be absolutely flawless.
Let's start with a really common trap, especially for NRIs trying to sell from abroad, the power of attorney, or POA. Now, it seems like a super convenient solution, right? But it is so incredibly easy to get wrong, and the consequences can be serious.
Just take a look at this case. An NRI in Australia used a POA that wasn't done correctly. The buyer's bank just rejected it, flat out. That one mistake caused a 5-week delay. The original buyer got tired of waiting and walked away, and the NRI had to scramble to find a new buyer, ultimately selling for almost 5 lakh rupees less. A single paperwork error had a huge financial cost.
So, what are the big mistakes you need to avoid? First off, never, ever use a generic, general POA. It has to be a special POA drafted specifically for that one sale. Second, it must be officially signed and stamped at an Indian embassy or consulate where you live. And third, and this one is critical, it has to be stamped again or adjudicated back in India within 3 months. If you miss any of these steps, that document can become completely worthless. Okay, the second big documentation issue is what I call the missing document dilemma, and this is super common, especially for properties that have been in the family for a long, long time.
It's a scenario so many NRIs face, right? What do you do if you can't find that original purchase deed from 20 years ago? Because without it, you can't prove how much you originally paid. And if you can't prove your cost, the tax office can legally say your cost was zero, which means you'd be taxed on the entire sale price. The stakes are just enormous.
Luckily, it is possible to reconstruct this history. You can get certified copies from the land registry, you can dig up old bank statements, you can ask the builder for allotment letters, or you can even hire a professional to create a valuation report for the year you bought it. There are definitely options, but the key is to start this detective work as early as you possibly can.
All right, now for the final hurdle. This is where everything we've talked about really comes together. The process of actually getting your money out of India and into your overseas bank account.
The good news here is that the rules are actually pretty generous. An NRI can send up to $1 million out of the country from a property sale, and that's per person, per financial year. So, not bad at all.
Now, the process for this is very, very structured. First, all the money from the sale has to land in your NRO bank account in India. Then, to move it abroad, you're going to need a whole package of documents. This includes a final report from a chartered accountant that certifies all the taxes have been calculated and paid correctly. Once you have this complete package, you give it to your bank, and then they can process the wire transfer.
And you see, this is where all that prep work we talked about pays off. Your paper trail is literally your money's ticket home. The bank is going to go through every single document with a fine-tooth comb. If the sale price on the deed doesn't match the TDS certificate, or if that tax calculation looks a little off, they will reject the transfer. Every single piece of paper has to tell the exact same, consistent story.
So, we've covered the major pitfalls and, more importantly, the key solutions. Let's boil all of this down into a final, proactive checklist to make sure your sale goes as smoothly as possible.
Here are the 5 absolute key takeaways. Number 1, start early. Begin calculating your gains and gathering your papers at least a month, maybe 45 days before the sale. 2, get the LDC. Applying for that lower TDS certificate is the single most important thing you can do to protect your cash. 3, perfect your POA. If you're selling from abroad, make sure you use a special POA and get every single detail right. 4, reconstruct documents. If you know you have missing papers, start that process of rebuilding the file right now. And finally, number 5, prepare for repatriation. From day 1, keeping a perfect, clean file ready for the bank.
So, we end right back where we started, with a simple question. Is your property in India a locked-up liability that's just causing you stress? Or is it the valuable, liquid asset it's supposed to be? As we've seen today, the only thing separating those two realities is preparation.